This presentation is titled How to Defer Capital Gains Taxes in Real Estate Syndications or Other Highly Appreciated Assets Using a Deferred Sales Trust, and mainly the 3 secrets to an optimal timing transformational exit plan. Okay, and so these would be some of our themes throughout the presentation. This is actually a client of mine. His name is Dave. He recently sold the property in Georgia. He's in Northern California in San Rafael. And he saved $1.1 million. We're going to talk about his story. Actually saved his failed 1031 exchange. And that's going to be this kind of the main story we centered this presentation around, how I helped Dave to finally achieve relief in retirement when he sold a $7.6 million multifamily building and saved $1.1 million in tax without having to do a 1031 exchange. So my name is Brett Swarts, and I'm the founder of Capital Gains Tax Solutions here in Northern California. Originally from Fremont, Mission, San Jose, where she lives now, and spent a lot of time in the Silicon Valley with my dad building homes, custom homes and rentals all throughout the Bay Area, okay? And so as a legal disclaimer, this message is for educational purposes only. I'm not a CPA nor a tax attorney, although we work with some of the best in the nation on who do provide the actual legal services, okay? But we strongly urge you to bring your independent legal counsel to review anything that you see in this presentation or implement any of the strategies we're going to talk about. But the first thing we have to understand is what's called the perfect storm, and it's facing many baby boomers, okay? And this is according to the American Bankers Association. There's about $17 trillion of assets that will pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And these baby boomers, there are about 77 million in the U.S. alone. And every single day, about 10,000 baby boomers return 65. Okay, and they're challenged with a massive amount of wealth that's tied to mainly 3 asset classes. In fact, according to the same study, there's about 50% of the total assets in America are tied to high-end primary homes, commercial real estate, and private equity or businesses. And you couple that with interest rates hovering near 40-year lows, real estate has appreciated a great deal over the last number of years. And then you also add in the 1031 timelines, which, by the way, only work for investment real estate, not for a primary home, not for cryptocurrency, not for private artwork or collectibles, and most of the time not for syndications either. You couple that, and it makes it very challenging to make a deal make sense. Kind of what Alex was referring to in the very beginning when he talked about we sell in California and then we go to other states, right? And so the key is having time to do that, which we're going to talk about. And then, of course, low inventory, which is just very, very challenging, okay? And so the whole premise that I want you guys to focus on is that most high net worth individuals, they struggle with capital gains tax, and it's somewhere between 30 and 50% of their gain when they go to sell their high-end primary home, commercial real estate, or business. And we use this tool, and this tool is called a Deferred Sales Trust, not to be confused with a Delaware statutory trust, which is also known as a DST, to give you tax deferral, liquidity, diversification, the ability to say goodbye to the 1031 exchange forever so that you can create and preserve more wealth, okay? And it's the best kept secret, I think, in real estate and for every high net worth individual. So back to the screen share here. Again, what are most baby boomers trapped by? Or even just, you don't have to be a baby boomer, anyone who's selling a tech company, who is selling private or public stock, who's selling, artwork or collectibles or cryptocurrency. They're struggled with somewhere between 33 and 50% of their gain being wiped out by depreciation recapture and capital gains tax, state, federal, and then the Medicare tax, okay? So every single day, high net worth individuals like yourself are paying hundreds of thousands of dollars, if not millions of dollars in capital gains tax when they don't have to. So this is Dave. Remember we talked about Dave? This is an actual client of mine. We actually closed this deal. So he was sitting in your shoes about 1 year ago seeing the same presentation. And this is what Dave said about why he wanted to use the Deferred Sales Trust. He says, Brett, I wanted to be able to time the real estate market. So have you ever felt like maybe, if you could have unlimited timing, you can make a better deal? He said, I wanted to be able to buy commercial real estate when it was more of a buyer's market. Do you think the Silicon Valley is a seller's market or a buyer's market, right? He wanted to be able to buy at a lower priced market when the deals made sense, right? He didn't want to overpay for property right now and take on a bunch of debt. He also didn't want to start over with a new 1031 property. And in fact, during his exchange deal, he actually sold this property in Georgia. And Dave has sold hundreds of properties for over 30 years. He's a commercial real estate operator, owner, developer, expert. He's done numerous 1031 exchanges, so he knows the 1031 in and out. But he didn't want to start over with a new 1031 property. In fact, the properties he was looking at were 4.5% to 5.5% cap rates, and they were very low. A lot of the value has been added. A lot of the rents were increased, and he's going, it's not a good time to be a buyer. So this is right before COVID-19 hit. And then what actually just solidified his conviction was that COVID-19 did hit. And when that happened, he said, forget about it. I'm going to the Deferred Sales Trust. And we actually saved his failed 1031 exchange. His funds were sitting at the accommodator. He had $7.6 million that he needed to replace for an equal or greater value property. He had about $3.1 million in equity and about $4.5 million of debt. And so he was able to retire all of that debt and just move the proceeds into the trust. And he said, Brett, I wanted to be able to retire from the toilets, trash, and the management. I wanted to get rid of my liability and all my debt. And I wanted to be able to trade that, not for another property, but I wanted to trade it for time, for travel, for liquidity, for diversification, and really just for retirement. But his plan is, look, Brett, I actually do always love to do deals. I just like to do deals when they make sense. So he plans to keep the funds in a conservative portfolio of liquid investments such as stocks, bonds, mutual funds, also hard money lending, and then have the funds shifted into commercial real estate when the prices make sense. So who is this presentation for? This presentation is for you, anyone who's who's an ultra high net worth individual or has a highly appreciated asset, okay? You might feel real estate rich or business rich and cash flow poor, right? You're selling or might be selling an investment real estate property, a primary home, or other assets such as cryptocurrency, such as artwork and collectibles, and you have a capital gains tax that you're facing, and that asset is worth somewhere between $1 million net of all debt, all closing costs, and the asset has more than about $500,000 of gain. If the gain is too small, the deal's too small, this doesn't apply, okay? Why? Because our fees will eat it up, but everything else, it will apply, and we'll show you why. So first of all, what is a deferred sales trust, and why do you need one for your wealth plan, okay? Well, I want you to think about Blockbuster versus Netflix. And do you remember those days when Blockbuster, I don't know if you remember this, Alex, when it'd be a Friday night and you drive to the Blockbuster and you want to see that favorite movie of yours, and so does everyone else, of course, so you're hoping to get there a little bit early before the crowd takes all the movies and they're all sold out. And so you're walking around the corner and you see that piece of cardboard and you see the movies that are stacked behind it. Maybe there's one left and you think it's your opportunity. Well, as you walk up to that movie and you're about to get it, there's two aisles between you and somebody cuts you off, walks you right where you're about to walk, looks at you as he's taking that movie, and now all of your dreams for your Friday night have been shattered, okay? And you're like, oh my gosh, I wish there was a better way. I wish there was a seamless way where I didn't have to worry about it being sold out. Or even if you got the movie, what did you have to do? Well, you had to go check it out, you had to drive back home, you had to put it in the movie, in the VCR, and then you push play, and what happens? Oh, you got to rewind it now. Now you got to spend the next 5 or 6 minutes rewinding it. Okay, so you rewind it, you watch the movie, but then you missed that 3 days. That 3 days, and then you get that fee, and then you go back and you forgot to rewind it, and you got another fee. I mean, all of the challenges with the old Blockbuster are kind of like with the 1031 exchanges. Okay, you got 45 days to identify. You got 180 days to close. The whole entity must move. You have to buy equal or greater value, which often means equal or greater debt. You typically have to sell high and buy higher 180 days later. You can't go into other asset types. Oftentimes you can't go into syndications because most syndicators don't allow any kind of 1031 into their deals unless it's a really big deal. And then sometimes they may carve something out for you. But the point is, it's very, very restrictive. It's like the old Blockbuster, right? But guess what happened? Netflix came along. And by the way, what did Netflix do? First 2 years in business, they came to Blockbuster and they said, hey, we think we have this cool idea. Would you like to buy it? And they said, well, how much are you selling it for? They said, well, just $50 million. Just buy it for $50 million. Blockbuster said, no way, $50 million. Tell you what, Netflix, we'll do this on our own. We'll figure this thing out. We've been in this game long enough. Fast forward, we know what's happened, right? Blockbuster is now bankrupt, and Netflix is now one of the largest media companies in the world, okay? And so I want you to think about Blockbuster as the old 1031, and I'm going to propose to you that the new way to do it is the Deferred Sales Trust. And it's going to give you a seamless way to buy and sell real estate, all tax deferred, go into debt or not go into debt, buy real estate or securities or do hard money lending, buy it at any time, move funds outside of your taxable estate, go into multiple syndications of your own or with partners. In other words, Netflix, we can all agree, is a lot better than Blockbuster, right? And for all of the apparent reasons of how easy it is. Well, that's what we're going to dive into right now. So be thinking about the old way versus the new way. But the deferred sales trust is just an installment sale. It's known as like a seller carryback, okay? And it goes back to IRC 453, goes back to the 1920s. But it's tried and true. You know it as a seller carryback. If you don't, your CPA definitely does. But it's just a part of the tax code. It's actually really simple if you think about it, which we're going to break down here in a second. But I want to just make sure I cover this crystal clear, that you have this in your mind about the syndication challenges that you are facing. And so if you want to invest with Alex or Ashish in the next deal, one of the challenges, again, is you might be selling a primary home. In fact, we just closed a deal in Cupertino for $3.1 million. And guess what a primary home does not allow you to do? You cannot 1031 a primary home. It's why you have what's called the 121 exclusion, which states if you live there 2 of the last 5 years, you have $250,000 tax-free if you're single and $500,000 if you're married. So let's say you bought a house for $500,000, you're selling it for $1 million. No problem if you live there 2 of the last 5 years and you're married. It's all tax-free. In fact, that was my first deal. In 2011, I bought a property, my wife and I did, and we bought it for $135,000 here in Roseville. It was a foreclosure. It was like perfect timing. I was just new, starting out. We owned it for 2 years exactly, sold it for $250, and walked away tax-free because that's of that nature, right? But if you're selling that house right now, you cannot 1031 at all, right? But what you can do is move it into the deferred sales trust and then use up to 80% of those funds the next day to put it into a commercial real estate syndication, right? So that's really, really powerful, is having that flexibility. So also remember too, if you even were going to try to do a 1031 to a syndication, which again, 99% of the syndicators do not allow it, you're looking at timelines that are very restrictive, of 45 days to identify and 180 days to close. So if you ever felt tired of feeling pressured, tired of feeling rushed and forced to make these decisions within 45 days, the worst off is when the seller knows you're in a 1031 and they just hold you to the fire, right? Because they know you have to make this quick decision. Have you ever felt like you've overpaid for a property that otherwise you wouldn't have bought except for to defer the tax, right? Would you prefer not to buy in an overpriced market? Would you prefer to buy in a lower buyer's market, right? By the way, remember, our parents taught us to sell high and buy low. They didn't teach us to sell high and buy higher 180 days later. So the 1031 is not friendly to our parents' advice. Let's instead use the deferred sales trust to sell high and buy whenever we want to, which leads us into the second reason why you would consider the deferred sales trust versus the 1031 exchange, which it has to do with the depreciation schedule. So one of the number one reasons to actually own real estate, and I'm sure Alex and Ashish have taught you this, is the depreciation that offsets the cash flow that's coming in. So let's imagine you had $100,000 worth of cash flow on a $3 million asset or so, okay? Well, about $20,000 or $25,000 per year on a multifamily property, it's about 27 and a half years for the depreciation schedule, can be used to offset that income. So although you have 100 coming in, you're only getting taxed on 80, right? That's the power of commercial real estate and cash flow investing. Now, if you can leverage that in a syndication, you get a percentage of that too, which is amazing. Well, guess what though? Eventually, if you've owned that property for long enough, 27 and a half years for multifamily, 39 years for commercial, your depreciation schedule goes to zero. Oh no, that's not good, right? It's actually like a client of mine here in Northern California. He owns a $10 million multifamily property, and he's owned it for over 30 years. So he has zero depreciation schedule. He's bringing in about $500,000 a year in cash flow, and he's just getting hammered with tax. So that's not good. So the intent is to get more depreciation. The challenge is the 1031 exchange. Guess what? If that client sells at $10 million and buys another property worth $10 million, still a zero depreciation schedule. Not good. But if you were to buy, let's say, a $25 million deal, well, now he's going to get some more depreciation, which is great. But better than that, why not get a brand new depreciation schedule through the deferred sales trust? And that's exactly what it allows you to do. You can now sell high, fully depreciated asset, move all the funds into the deferred sales trust, and the next day buy the same property that you would have purchased in the 1031, and guess what? Get a brand new depreciation schedule. So if that part doesn't blow your mind, I'm not sure what will, but be please writing your questions in the comments here, because we're going to dive into how this thing all works in a minute here. But diving back into the syndication, the whole entity must move. So another challenge that syndicators have is they have multiple partners. And let's say they have 10 partners in a single deal. And not only did they not allow 1031 money in because it was too complicated, but now they're going to sell and they have this exit going on. Well, what happens? Everyone typically gets all their money back and they all just pay their tax. Ouch, right? We all just paid 30 to 50% in that depreciation recapture, right? We had the cost segregation, which was amazing for the first couple of years, but now it's all coming back to bite us because the whole entity must move. Generally speaking, that means all of the partners must agree, and then they all must go buy another property, which they get stuck in the 1031 rat race, which they're overpaying for property, which is not good. But again, a lot of times it's better than paying the tax, but a lot of times they don't even do the 1031. They say, forget about it. everybody pays your tax because we can't agree on this. Not so with the DST. We can have each individual go into each individual deferred sales trust, or let's say there's 10 of us, 5 of us could pay our tax, and the other 5 could do our own DST. No longer commingles anybody. We call this the seamless partnership separation. Also, for the current owner or the syndicator or general partner or sponsor, they have what's called carried interest, right? And that carried interest is taxed as capital gains tax. Well, guess what? For their carried interest, that capital gains tax, we can move it into the deferred sales trust. So I say at the very end of here, don't be this guy. He wants to buy high, sell higher, don't do that. Buy low and sell high, okay? That is the key here, okay? So we cover what the Deferred Sales Trust is. As a quick background, by the way, I started my career out working for a company called Marcus & Millichap. It's the largest investment real estate firm in the nation, specializing in real estate investment sales, okay? I've sold nearly $88 million as a broker, mostly multifamily here in Northern California. I actually grew up in the Bay Area, helping my dad buy and sell and develop mostly single-family homes throughout the entire Bay Area. And so I've always had like the real estate blood in me, and I always loved it. I've also personally, passively, in over $100 million worth of senior housing, mixed-use, industrial, retail, multifamily syndication deals. That is my #1 asset class for me investing, so I love commercial real estate. And I've also closed countless 1031 exchanges, Delaware statutory trust, deferred sales trust, and I have my Series 22 and 63 license. And so I've been featured on some of these cool podcasts here, and you might recognize some of these folks. And I've also been featured on Sharkpreneur. Kevin Harrington, he's with Mark Cuban on the Shark Tank. You might recognize him on the left. And I've been on their podcast, and I'm actually working on a deal for one of Seth Green's clients right now. But enough about me. I want to start you at the beginning and then walk you through how this thing all works, right? This is Leonardo DiCaprio. This is not me my first year in the business. In fact, it was my cousin, and my cousin was my mentor, and he taught me how to be a broker. Okay, while I was at Marcus & Millichap. I was more like one of the guys in the background, looking like, scratching my head, like, how does this thing all work? And it was 2006 to 2010, this time frame, and I was really a broke, just married, just out of college, commercial real estate agent trying to make it in the business. And in fact, you either sink or swim. You either get a commission or you make nothing. There's no salary, there's no benefits. And so I really wanted to live my dream of being in commercial real estate, making it as a career, but it was very challenging, right? And a lot of folks were just saying, go get a real job, go get a W-2 job. You have a family at home, and I was trying to support my daughter and my wife. My wife wanted to stay home full time, but it was really tough. It wasn't easy. And the thing was, I was only earning like a few $1,000s a year. And in a few years, I actually had a goose egg. It was so challenging. I'll talk about that in a minute. But it also helped me to adapt and to grow and to look at different opportunities and different ways to solve problems. And I remember it was this random Wednesday afternoon, and I just poured my blood, sweat, and tears into multiple deals, and they all just completely just fell apart. And I don't know if you've ever been somewhere where you felt scared and frustrated and like you gave everything, but all of a sudden all that stress started bubbling up. And I remember just starting to cry with my mentor. Like I'm not a crier, but I just couldn't hold it in anymore. And I felt like a failure. And part of the challenge was growing up, I saw my dad, and he had a lot of money, very successful, but the majority of the time I lived with my mom, and she didn't have any money. In fact, my dad really didn't give her any of the money, and so we grew up really humble with my mom mostly, and then I would visit my dad during the summers and help him build houses. And so I always knew that I didn't want to have this struggle in my life. I wanted to be financially free. I didn't want to have to think about money. I was going to work really hard in school and learn how to have wealth. And so I was just getting going in the business and just starting to get some momentum as I learned from really smart professionals at Marcus & Millichap. But then something happened, right? And that was the big 2008 crash. And this was like a brick wall for something where I was already just barely making it. So I went to making this a little bit to literally like zero. And so now folks are like, really get out of the business. You have a baby at home. You got to do something. But I knew I wanted to stay in the business. So I did what every good entrepreneur does. And you go and get a side job and a side hustle, and you just keep learning and growing. But the biggest challenge was I was still closing some deals, but this is a deal here in Sacramento. It's a $129,000 deal. And a 3% commission, after Marcus & Millichap takes 50% of it, it's $1,900. So to try to support my family at home, this is barely making it by. But I said I have to win. I have to figure out a way to make it in the business. So what did I do? I set out on a plan, and the plan was to work. I worked at Cheesecake Factory. That was our favorite restaurant. So by night, I'd be at Cheesecake Factory. By day, I'd be making cold calls to people and helping them to try to sell their real estate, right, as a broker. And so I'd actually have the same tie on that I was wearing at Marcus & Millichap. I didn't even have to, I just didn't have to untie my tie. I just put a different shirt on. So this is actually my manager here on the left. His name is Kerry, and he's there wearing the tie. That is not me in the background, but I looked something like that when I was in my mid-20s. And this is the Roseville Cheesecake Factory here in Sacramento. But also during that time, it wasn't just me facing challenges. It was also my clients. And this is the part where I think it's going to be transformational for you, hopefully, or maybe you remember those times of how scared you were of losing everything in '08, right? When some people lost everything, some people lost half, and the debt and all the pressure and all of the stress. And so I saw a lot of my friends, family, and clients, some who lost everything, and so we tried to dissect what was happening beforehand and what could they have done differently. And just at that moment, I met somebody, and that somebody was my business partner now, who Marcus & Millichap brought in to speak to us and give this similar presentation on the Deferred Sales Trust. So if you've ever had that moment where you're sitting there and time is kind of slowing down and you're learning something new and your brain is starting to open up to new possibilities, well, that was that moment at Marcus & Millichap in Sacramento, as he told us that you never have to do a 1031 ever again. They could have been out of debt. They could have been diversified. They could have been on the sidelines. And it was as if everything became crystal clear. And so the plan was learn this and execute it inside of your business with your clients and help them create and preserve more wealth. And so that's what I started to do. All of a sudden, as I started to learn about this, apply it, and use it for my clients, my business started to grow. And I started to be more successful. And so fast forward over 10 years, 11 years using the structure and the strategy, we now have 5 kids. I've been able to keep my wife home full time. And more than that, I've been able to create a lifestyle for myself and help my clients do the same, where they don't ever have to feel trapped by capital gains tax, and they can actually create and preserve more wealth, and they can lower their overall risk. And so now I travel around the country speaking on this, and I train Marcus & Millichap agents now. I've been in the San Francisco office, the Oakland office. I've been in the Colliers downtown San Francisco office, training all of their multifamily brokers. I've been in Florida training multifamily brokers. So I just train everybody now, and we also have our podcast. But here's the key. Here's the thing, though. After 10 years of doing all this, I discovered the hard way how to do this. So how many of you want to learn the easy way? And if you do, put that in the comments, and please tag somebody, too, you could be thinking of who this could help in Facebook Live so they can get the word out more, okay? We really appreciate that. And by the way, if you've been struggling with capital gains tax, if you've been struggling with the 1031 exchange, this is probably why, right? And before we go there, though, it's not your fault. Your CPA didn't know about it. But the perfect storm is facing you, baby boomers, and anyone else who has a highly appreciated primary home, business, or commercial real estate, and it's happening right now. So that's just the demographics. There's low inventory. It's tough to find deals. We've already kind of established that. But most CPAs don't know about it until they talk with us, and then they sign up with us and they roll it out to all of their clients. But it's not your fault, okay? I want to let you know that. And it's okay. Everyone has to learn this at a certain point. Also, I want to let you know, and a little secret, your commercial real estate brokers and the 1031 exchange companies, hey, they don't want you to know about this. Why? Because they get paid on transactions, and they get paid when the money's sitting there. So they don't want you to know about it. They want to keep you in the 1031 rat race, overpaying for properties, chasing deals, taking on more debt, all within the 180 days so that they can make a bunch of money. Now, not to say that a 1031 is not a good place to do it. There's times to do it and there's times not to do it. When it's a buyer's market or there's a forced appreciation opportunity, by all means, go for it. But remember, 1031 only applies to investment properties, often does not apply to syndications, and oftentimes you're also selling and buying in the same market, which is not good. So if you try to do a traditional 1031 exchange, you've no doubt felt pressured and trapped by under the 180 days. We call this the sell high, buy higher with more debt 180 days plan, or in other words, the 1031 rat race. The opposite is freedom from capital gains tax. The 1031 does not work anymore. It's the old blockbuster. So the hard way, this is what we used to have to do for the past 10 years. Hire a broker, 5 to 6% commission. Sell your property, 0.5% closing costs. Hire attorneys to review documents, $1,000. Hire a 1031 exchange qualified intermediary, $750. Hire an attorney to draft a new LLC, $1,500. Identify 3 properties within 45 days and close within 180 days. That creates pressure. Apply for a loan, 1% origination fee and closing costs. Buy another property. Hopefully you didn't overpay. Take on more debt than you probably wanted to, feeling more pressure. Your upfront costs, hundreds of thousands of dollars per deal, depending on the size of the deal. The time to do all this, probably 6 months just to sell your property and then buy another property. And then post-close, you have to hire new property management, new leases, new utilities, new laws, new collections, new evictions. It's endless, okay? This is also probably why it's a good thing to be able to invest with Alex and Ashish, right? Because they're going to do a lot of this for you. They're going to vet the deal. They're going to hire the brokers. They're going to go through it all and hopefully negotiate a great return for the partnership, which I believe they are doing, and still get all of the benefits of the cash flow real estate and hopefully out of state at a better price too, by the way, okay? So I'm going to walk you through how to build an entire optimal timing wealth plan and live in the next 30 minutes. You ready? Here we go. We're going to move really fast now, okay? So there's 3 secrets to this optimal timing transformational wealth plan or exit plan. Secret number 1, selling and deferring hundreds of thousands of dollars to millions of dollars in capital gains tax. How to legally break free from capital gains tax and find freedom to buy and sell your business or property without ever worrying about a 1031 exchange ever again. Secret number 2, optimal timing transformational wealth plan cloning. How to clone a proven wealth plan with capital gains tax solutions in less than 5 hours and have more time, energy, and debt freedom without giving up control or protection of your cash. Secret number 3, my number 1 wealth building hack. How to get your deferred sales trust to work in your favor and become an investment rather than an expense. So secret number 1, 1031 exchange hacking. How to legally break free from capital gains tax to find freedom to buy and sell your business or property without ever worrying about a 1031 exchange ever again. So I want you to meet Joe, and Joe wants to sell his business or property or commercial real estate, but he feels trapped. What's he trapped by? He's trapped by the 30 to 50% in capital gains tax and or the 1031 exchange. In fact, it really hurts to overpay and not be able to sell, so he gets frustrated. So this too often is too many people's story before they meet us, and they're just frustrated and they feel trapped, and they don't know what to do, but they want to be able to retire, be out of debt, have a more passive income stream, invest in commercial real estate when it makes sense, but they don't want to necessarily do another 1031 and repeat the property, the pressure and the frustration all over again. So what's step number 1? Well, the step number 1 is to determine your capital gains tax liability. You can go to capitalgainstaxsolutions.com and schedule a one-on-one consultation or use our Deferred Sales Trust calculator to give a side-by-side comparison. But let's just determine what you're selling for, what the basis is, and let's determine what your actual gain is, therefore what your liability is. Step number 2 is to envision your ideal wealth plan. So I want you to picture what that looks like in 1 year, 3 years, and 5 years. I want you to picture how much time and energy you're spending on this. I want you to picture how much debt you have. I want you to picture how much cash flow you need or want to come in. I want you to picture the opportunity to give more to charity or to fund your next business venture or to develop real estate. I want you to picture what your ideal wealth plan looks like, okay? And then step number 2 is just to look at a side-by-side comparison of using the Deferred Sales Trust versus the 1031 exchange, okay? And what actually helps you get there. One of them you have to stay in debt. You have to stay in investment real estate. The other one, you can go into investment real estate at any time. You don't have to take on any debt if you never want to again. One of them is very difficult to get into syndications. The other ones, you can get into syndications no problem. One of them, if you're selling out of your syndications, you typically are just going to pay the tax. The other one allows you to defer the tax. One of them you can use to sell a primary home or a business. The other one doesn't allow you to do that. One of them gives you liquidity. You can put it in stocks, bonds, and mutual funds and just access the cash really quick. The other one, you're in illiquid assets, okay? One of them gives you diversification. The other one typically doesn't. I think you're getting the idea. Blockbuster versus Netflix, okay? But envision what that looks like, write it out, and see which one gives you what you're looking for. Step number 3, just talk with someone who's successfully used the Deferred Sales Trust. We've closed thousands of deals over 24 years, multifamily, self-storage, dentists, veterinarians, doctors. We've done Netflix stock, private and public stock, S-Corps, C-Corps, LLCs, artwork and collectibles, car dealerships, okay? Talk with our list of clients who have done it, okay? Step number 4, just sell your asset and fund the Deferred Sales Trust. Funds are held at TD Ameritrade, Bank of New York Mellon, Charles Schwab. They never move without your signature. You have 24/7 access to view the funds. But remember Dave? He was in your position 1 year ago, right? And he wanted to be able to time the real estate market. He did not want to start over with a new 1031 property. He wanted to retire from the toilets to trash, the management and liability. And right now he put $2 million into a hard money lending fund that's liquid and pretty conservative, but they're returning about 6%. But he has no toilets, no trash, no liability. It's a firm that he trusts and that we work with. But he plans to keep the funds invested into this conservative portfolio of liquid investments, and then he's going to wait for the market to shift. And he goes, Brett, I want to buy a deal when the deal hits me over the head. And that might be 6 months, that might be 24 months. He goes, but I'm going to let the sharks feed. I'm going to let all the sharks feed and all the blood in the streets. And then when the market starts to stabilize, I'm going to buy. And then likewise, I'm going to sell before it's too late. Okay, and that's kind of what he did on his deal here. He's really smart about that. And that's his plan. Okay, so how does this all work? Alex or Sheesh, are you guys ready to participate?
Well, we have some comments. If you can slightly slow down, Brett, you talk very fast.
I'll try to slow down, but remember, this is being recorded, and we have so much to cover, okay? So you can always go back and rewind and watch it, all right? but
right.
I will try to slow down a little bit. All right.
But we try to, just so that you guys know, there's a lot of slide, a lot of information. Typically, Brett does this in an hour, but what we'd like to do is, we'd like to keep it under an hour, including your Q&A. So that's the reason I actually asked Brett to speak a little bit faster.
But I will stay after the hour for extra questions too, for anyone who wants to stay with me. Okay. So here we go. Alex, you ready?
Yes.
All right, so we're going to use Alex. He bought a $1 million property, a multifamily property, and he bought it 10 years ago. And he added value, and he's really happy. He's about to sell it for $5 million. But it's in the state of California, so for tax purposes, he's looking at state, federal, Obamacare, as well as depreciation recapture. And so this is a $4 million gain, okay? On that $4 million gain, he's looking at about 40% collectively, okay? So we're looking at, let's say, about $1.3 million. So, Alex, if you do nothing, you're going to pay $1.3 million of tax. Would you like to defer that, Alex?
Yes.
Okay. Let's make it simple. Let's imagine he owns it free and clear, okay? But the first thing to understand for Alex is if Alex receives the cash directly from the cash buyer, he's going to take what's called $5 million of actual receipt. That means the money has hit his hands, his personal bank account, which is going to trigger this $1.3 million deal, or tax here, right? Which he doesn't want to do. So the key is to keep it outside of Alex's hands. Well, how do we do that, right? Well, we simply are going to move the funds to the trust instead of moving it to Alex, okay? So here's the $5 million right here, asset to sell, and the buyer is ready to go. He has the $5 million. He's actually just going to sell it to this trust right before close of escrow. It's like a simultaneous close. It's actually an assignment of sale. And he's going to sell it for $5 million. And guess what the trust is going to do, Alex? It's going to turn around and sell it for the exact same price that you sold it for. So, Alex, are you ready? If the trust bought it for $5 million and sold it for $5 million, Alex, how much gain does the trust have?
0.
You got it. Now, Ashish, how much tax is due on $0? 0. I don't know if you can hear him, but it's 0. Yeah, you receive 0. You can't pay tax on nothing, right?
I think he's speechless.
He's speechless, right? Okay. It's actually really simple. Not a trick question. Trust bought it for $5 million and sold it for $5 million. That means there's 0 gain. That means there's no tax. Okay. Now, what happens for Alex? Well, Alex, you're going to receive a promissory note, and this promissory note, guess what the number is going to be? It's going to be owed you is $5 million. So it's a promissory note, and you received a 0 down payment, Alex. So, Alex, if you received a 0 down payment, how much tax is triggered today, Alex?
Also 0.
You got it, right? Because what you did here was just 100% seller financing. You just carried back paper, right? Seller carryback. This first part of the transaction, you just did a seller carryback. We were just creative on how we did this. We had this buyer ready to go with the $5 million, who's actually going to buy the asset from the trust and put the $5 million into the trust. Okay. Now, once the $5 million is in the trust, this is where the world is your oyster, Alex. Are you ready? And many questions, by the way, on what just happened right there.
No, I think I'm following.
Any questions there? Did you get that? This is really important. This page right here, where we keep going here. I think you got it. Okay. And we'll run through it again. Selling it for $5 million. He's going to sell it to the trust for $5 million. Who's going to turn around and sell it for $5 million, and therefore it's a 0 gain. The cash buyer is going to put the $5 million into the trust. Since Alex carried back 100% seller financing and took a 0 down payment, his tax liability of 1.3 is in a deferral state. You could also think of this little DST like a 1031 company, right? In fact, this is sort of how the 1031 works too. The $5 million goes to the QI company instead of going to Alex's hands, and therefore it's in a deferral state. And Alex wouldn't pay any of this tax until he receives what's called boot, right? Any of this $5 million principal balance, okay? Just in time, by the way, this used to be a 3% return on equity. Alex, so that's why Alex was selling it, right? He couldn't get out of the equity. So all of a sudden, there's this multifamily property over here. And what's really cool, maybe Alex, give me a deal what's the state that you buy in?
We recently closed one in North Carolina.
Okay, North Carolina. What was the cash on cash?
7 to 9%, depends on share class.
Awesome. Okay, let's just use 9%. So what was cool was I used to have Alex, used to have the toilets, the trash, the liability, all of the stuff over here. He's dealing with California rent laws, and he can't evict people, and he's frustrated. He's making 3%. But he goes, you know what? I got this deal over here. I can triple my cash-on-cash return. And I can also, oh, by the way, he was fully depreciated too. He's owned this for 27 and a half years. Let's use that one better, right? So now he's not getting any more depreciation. Well, guess what? He moves it into the trust. The next day, Alex can form an LLC. Okay? And Alex, you're the managing member of this. And guess what? Up to 80% of this $5 million, which would be $4 million, can be sent to this LLC. And then it can invest into this deal. So we're going to get a brand new depreciation schedule. We're going to triple our cash-on-cash return. We're going to get rid of all the toiletry trash and the liability and all the rent control and all the tough things to own in California. And we're going to invest over here. Now, how we do that is through what's called a JV part. It's kind of like a self-directed IRA, but it's not loaning him the money. It's doing what's called a JV partnership. This is very important. And because we JV Alex, we're going to set this up with an 80% to Alex to start, okay? Even though Alex, you're going to put up 0 down payment.
No question here, Brett.
Sure, go ahead.
So for the $4 million, there is no tax. There won't be any tax obligation when you move funds from Deferred Sales Trust to the LLC?
No, as long as it's business purpose, such as this multifamily apartment complex. This could also be a startup company. This could be ground up development. As long as it's investment or business purpose, there's no taxes triggered, okay? Alex still hasn't taken any of the money. He just went to this LLC that's investing. And by the way, in the meantime, this other $1 million over here, stocks, bonds, mutual funds, some of the largest companies in the world, okay? Netflix, Costco, Apple. In fact, the company that we work with, when the market was down 37% in 2008, they were only down 4.5%. Okay? The next year they were up 25%. So Alex doesn't have to take a bunch of risk in the stock market, right? He's back to say, I'm not really a stock market person. He's just going to use this as a placeholder. He's just going to use this. And by the way, this property, let's say it costs $10 million, but because Alex waited, let's say a year before he bought it, he didn't do a 1031. Let's say he could buy it for $9 million, right? He waited for the market to shift, and this is the power of this. So not only did he save $1 million here because he bought it at a discount, but he did it with a brand new depreciation schedule, and he did it all tax deferred. Okay, so we've done thousands of these. Okay, 15 no change IRS audits, not one single issue with the IRS, no pending litigation. We execute these all the time. Okay. Now you're looking at this going, this is a lot going on. We don't. This is why we're the experts, but this is the crash course. Okay. So fast forward, you sell this property for a $3 million gain. Okay. 5 years later, what happens? Well, you got to pay back the original $4 million, and we actually had an 8% preferred return. We typically mirror the note. Our notes are typically 8%, 10-year terms. Okay. Due in 10, which you can renew every 10 years. We're going to get that to in a minute. But essentially, 80% of this $3 million, Alex, is going to go to you personally, even though you put up $0. And the other 20% is going to go back into the trust. But you're going to say, I don't want to pay all that tax, Brett. This is going to hit me. Well, no problem, Alex. Why don't you just roll it into your same deferred sales trust? Okay. And then we call it rinse, wash, repeat. And we just do it all over again. Selling high, buying low, like our parents taught us to do. Riding the bike the first time, guys, is going to be a little wobbly. You've never rode the bike before.
Difficult, yeah.
But when you ride the bike once, twice, and you're with us, you're going to get it. And you're never going to want to use a 1031 exchange it again. So I'm going to clear all those drawings. I'm going to walk through it one more time. Just the first part, $5 million sale straight to the trust. Why does he do that? Well, he's carrying a note, 100% financing. $5 million. 0 down payment. So he's in a tax deferral state. The cash buyer is going to buy the deal. The trust bought and sold for the same price, so they have no gain. Buyer takes the title, he's gone. He's left with a promissory note. Promissory note are 10-year terms, typically interest-only payments, but we can set it up with no payments for a while. and interest only. Typically, our notes earn 8% net of the recurring fees, okay, over any 10-year period of time, which you can renew for every 10 years for 10 years. You just keep going. You can pass it to your kids inside the living trust and just keep this thing going. But if he goes into another real estate deal, Alex is going to get 80% of the upside, even though he's putting up 0 down payment, and he's going to get a brand new depreciation schedule. Okay,
Another
here we go.
question, Brett, if you don't mind.
Go.
Like 1031, there is a 6-month time period. So this doesn't have any time constraint.
0. We're not doing a 1031. We never want to do a 1031 ever again if we don't have to. 1031 is Blockbuster. You can go drive to maybe a random Blockbuster that hasn't closed down yet and go rent your movie. But I think you could just go on Netflix, Ashish, and just click on the Netflix.
Oh, this is amazing.
So that's why you have that flexibility where you could potentially time it, right? So in the meantime, if you sell something, what do you do? Is the money in a safe account, escrow, or
you got it.
Trust?
Yep, TD Ameritrade is where the largest bank in the world. The funds don't move without your signature, and you keep it in just conservative bonds, conservative whatever, just safe. I'm just going to hold on. Like right now, we believe it's the time to be liquid, diversify, and get your cash on the sidelines. Be ready, get your powder dry. Be ready to jump in. It may take 6 months, 12 months. Go ahead, Ash.
Sorry to interject. There's another important question that comes from this.
Sure.
What document do you need to provide to IRS? Let's say you're deferring taxes.
Yeah, it's just an installment sale document. And our CPAs and tax attorneys provide what's called white glove seamless transaction coordination. And so they're going to work with your personal CPA to check the boxes. They're going to work with escrow. They're going to work with the commercial real estate broker. That's all taken care of. We're going to talk about that here in a minute, and they'll work through that.
Okay.
Okay, we're going to keep going here because we got still a lot to cover. So remember, who does this all work for? Well, it works for a primary homeowner. The home needs to be worth $1.5 million or more for it to make sense. Business owner, car dealerships, tech entrepreneurs, dentists, veterinarians, optometrists, private stock, public stock, Bitcoin, collectibles, artwork, investment real estate developers, syndicators, operators, LLCs, S Corps, C Corps, okay, all types of high net worth clients. This is Steve and John, my actual clients, okay? I actually sold this multifamily property in Sacramento for $270,000 per unit as a broker. And Steve and John were forced to go with 1031 exchange. Well, midway through the 1031 exchange, guess what happened? Well, unfortunately, John's mother-in-law passed away. So that forced Steve to not have enough of a down payment for the next deal. But also, when Steve was looking at the property, he said, oh, 3% cash-on-cash return to go to a 4% with an extra couple $1 million of debt. I don't want to buy. This is before COVID-19, but I probably should. His family for 30 years in Napa have owned commercial real estate. They own about $30 million of multifamily in Northern California. So he has known and done 1031 all of his life. And for the first time, he chose Netflix. He chose the Deferred Sales Trust. It not only saved his 1031 exchange in hundreds of thousands of dollars, but also kind of saved his partnership, right? Because this was his friend and partner for years, and his partner was leaving him out to dry. And you can't blame his partner because a family emergency came up. But he used the Deferred Sales Trust, and you can actually see him right now, or after this presentation or whenever. I interview him, and he gives his whole story. You go to capitalgainstaxsolutions.com to learn more. All right, this is a business sale that we did for a transactional attorney in Las Vegas. He was actually selling his own business. He helped put deals together. He did it for his own business. So if you're wondering who's doing these deals, really smart people who have vetted us and looked at us and are doing the deals. Here's a few other recent closed and live deals. $47 million business sale in Florida, $80 million car dealership in Central California, $26 million primary home sale. I'll talk about that one here in Newport Beach. That was a couple getting a divorce, needed to sell, and they owed $6 million above and beyond their 121 exclusion. They could not do a 1031 exchange. They used the Deferred Sales Trust. And so till this day, they're still deferring all of that $6 million, and they're living off the interest. They're paying ordinary income tax on that interest. The largest deal ever was a $125 million deal in San Diego, and these are a few other ones that are under contract right now. In fact, this Palo Alto one was with one of the #1 realtors in all of Palo Alto for 30 years, and he's using it for his own primary home, okay? This is actually the deal in Cupertino. So this is Maxine, the engineer at Google. This is her $3.1 million house, and she deferred $400,000, and she wanted to downsize. You know, she wanted to relocate, but she didn't want to pay the massive tax, and so she used it. She traded an illiquid asset, what wasn't producing cash flow. Remember Rich Dad, Poor Dad? Your home is not an investment. It's a liability. She traded that liability, deferred all the tax for liquid, diversified investment-grade security. She also owns a multifamily property, and she may or may not go back into real estate because she kind of wants to retire from it all. But this is someone who just did that. Okay. So hopefully what you're gathering here is not only the blockbuster versus Netflix, but what we're talking about is transformational wealth, transformational opportunity to create and preserve more wealth, okay? And what it provides is debt freedom, right? We call it the Dave Ramsey plan for your commercial real estate or business. Just get out of all the debt. Don't do any 1031 and do equal or greater debt. Just get debt free. Of course, we're going to defer the tax. We got to defer the tax. But it's also going to give you a chance to diversify your wealth into multiple product types and multiple locations. You know, part of what Ashish and Alex do is they do multiple commercial real estate syndications and self-storage and multifamily in different product types and different locations, right? They're not just putting it all into Arizona or all just into Texas. They're doing multiple states, multiple product types. Well, guess what? Why don't you do that too? With your property, your high-end primary home, business, commercial real estate, sell it and say, hey, what can we put it in, right? Diversify. They're also getting liquidity, right? You can just keep it in stocks, bonds, and mutual funds. That's part of why we need to keep that 20% reserve in there. We can't give all 100% out to illiquid assets. We want to keep some liquidity. But that's great, which gives you some time to enjoy your wealth, right? No more toilets, trash, or liability. Also, opportunity to grow wealth at optimal timing. Buy when it makes sense, not when you have to, right? Buy when it's a buyer's market, not a seller's market. And then the legacy wealth transfer. We're going to talk about that here in a minute for the ultra high net worth individual. But the most important question you want to ask is, how do we know this thing is legal? And how do you know your funds are protected, okay? So step number one is the track record. Before you accept anything from anybody, including us, you want to know how many have closed. Well, for us, thousands of closes, okay? And how many of those have been audited? About 15, okay? Actually, 12 of them were random audits for high net worth individuals. The largest one was a $125 million deal in San Diego. The other three were just formal audits where they sat down and they said, hey, just let me see everything, okay? And they showed it all, and they closed them all out as no change audits. I mean, not one single issue with any of them, and that's actually pretty amazing. If you could imagine Alex or Ashish or I, and the IRS did an audit on us, the odds that they don't find even like one thing that's off, like an expense that didn't have a receipt or something we misreported, is very, very low. The Deferred Sales Trust, can you imagine how big these deals are and what the IRS was looking for? They didn't change anything, not one single issue. There's also what's called a private letter ruling that in the substance and form of the structure was approved. But remember, private letter rulings are for specific deals and specific cases, so it's not like just a blanket all. But all the other IRS audits and the formal audits have been reviewed. We've also been reviewed by FINRA. We've been reviewed by national law firms. And we have thousands of business professionals across the U.S., CPAs, tax attorneys, 1031 exchange companies. We've done deals with escrow, Chicago Title, Placer Title, Orange Coast Title, Fidelity, you name it, 1031 exchange services, legal 1031. We've done them all, okay, with a lot of these folks. So a lot of people have seen this, and the point is it's 100% legal and it works every time. And which leads into the next most important question, are there any pending litigation with the IRS? And the answer is no, no pending litigation. The other one is, of those audits, were they the actual clients of the tax attorney who actually did the structure and survived and defended? Yes. So you want to make sure you're working with the brain surgeon whose clients have actually been on the operating table and have survived the operation, right? None of the patients have died and none of the patients have gone to jail. Moving right along, the track record speaks for itself. But there's also audit defense in case you actually do get audited, right? What happens? Okay, well, you have audit defense all built in for the life of the trust. And there's also indemnification that the tax attorneys provide, okay? Next, how do you know your funds are protected? Well, you have what's called direct access control agreement. Funds only move with your signature. We use a $6 billion bank in Southern California to initially escrow the funds, and then from them they go to TD Ameritrade or they go to the LLC, which you have to invest in real estate, okay? And the funds only ever move with your signature, okay? I'm the third-party unrelated trustee, okay? I'm kind of like the offensive coordinator. It takes a third-party unrelated trustee to execute this trust. And then it takes the tax attorneys to form it, and then it takes the financial advisor. We're all like separate but equal powers. It helps to keep the integrity of everything intact. But there's also a third-party bank, and the funds only move with your signature, okay? Very important. I can't take the funds to Mexico and with Alex and Ashish and live the vida loca, right? It has to have your approval before it moves in investments or moves out of the funds, moves out of the bank. All right, that's secret number one. Secret number two, number three, we'll go a little bit faster, but here we go. Secret number two, Deferred Sales Trust Optimal Timing Transformational Wealth Plan. How to clone a proven wealth plan with our company, Capital Gains Tax Solutions, in less than 5 hours. Just give me 5 hours of your time and energy to talk with our tax attorneys, myself, the financial advisor, get Alex and Ashish on the line to figure out how and where the funds can be invested with their syndications, to gain more time, more wealth, more energy, pay off all your debt, without giving up control or protection of your your cash. So what's the plan? Well, Leonardo DiCaprio, he's one of my favorite actors. So what does he say? He says, anytime, my friend, okay? Sell, fund, and invest at any time. Optimal timing. Today, tomorrow, never again into real estate. Whatever you want. Let's customize it for your needs, your wants, and your desires when you see a deal. So step number one, we're just going to map out a wealth plan with me, Capital Gains Tax Solutions, and your trusted advisors. Bring in your CPA. Bring in your financial advisor. They end up joining us. Most of them do. And let's educate them. Let's get their blessing. We want their blessing, okay? And then we just fund your trust, and they give an allocation sample here. Now, you do need to use the financial advisors that we have here, okay? And if you're a financial advisor listening to this, call us, and we can get you signed up and going. But they're going to present an allocation. You're going to approve or disapprove of that, okay? And then you're going to get 24/7 access to view the funds online. Step number two, sell that property. Sell, baby, sell. Now is a great time to sell, especially if you're in California or you're in Silicon Valley. Sell. Step number three, fund your trust. Pretty simple. Step number four, enjoy your wealth. Give more if you want to, but you don't have to. We're like a CRT, except no C is required. You don't have to give it away to charity, but you can. We love that. Whatever you love to give to, you can have it fund charity. You can do 10%, you can do 90%, you can do 50%, whatever. It can also just pass to your kids. You don't have to give any of it to charity if you don't want to. That's fine too. Income overview. Typically, again, 10-year notes, 8% earning target net of all recurring fees. Renew after each year, each term for as long as you want. You can also cash out whenever you want. Just pay the tax. So remember, what we used to have to do, stay in our primary homes, not sell our business, overpay for a 1031 property, more time, energy, toilets, trash, tenants, employees, and liability. Become the lender for a single buyer. Someone might be saying, well, why don't I just become the lender myself and just cut everyone else out? Well, you could, but generally those deals are short in nature, 3 to 5 years, and the person is just going to pay you off anyways, refinance the property, and you're going to owe the tax, and now you forfeited the 1031. The second part of that is you're not diversified. You're dependent upon this one person, right? The collateral is just that one property. Instead, it could be in the top companies in the world. It could be multiple syndication properties, right? It could be liquid. It's also not liquid when you're with that person. And then you might have to foreclose, and they could run the business or property into the ground. That's why most people don't do traditional seller carrybacks, okay? But the law is there. The law is proven. Everyone knows it works. But this is where we get the Netflix versus the Blockbuster, okay? You used to also have to stay in debt, time, energy, stress, or just pay the tax. But there's a new way, there's a better way, right? So who here thinks the Deferred Sales Trust is awesome, is amazing, is transformational, can change your life, can fund charity, can do whatever you want in regards to building your wealth? If so, put yes in the comments. Please tag somebody. This could help out. Please give any positive feedback to Alex and Ashish for bringing this to you. So that is secret number 2. So secret number 3, my number 1 wealth building hack. How to get your Deferred Sales Trust to work in your favor and become an investment and not an expense. And this is Peter. This is a client of mine. In fact, he's not too far from you. He lives in Marin, California. He's been a realtor for 30 years. He's bought and sold multifamily property himself and has been an investor. And he heard about the Deferred Sales Trust about 9 months ago. Okay? And, gaining freedom from capital gains tax used to be very difficult, but not anymore. And Peter said this: it's a relief to be rid of the apartment building. It was a very lucrative investment, but it came with a lot of headaches that took up my time and energy. What was his headaches? Well, he was driving from Sacramento about 2 to 3 days a week, banging on doors in South Sacramento, trying to collect rents in a C- to D neighborhood, and trying to deal with management, and had gunshots in his car, and it's just an absolute mess. He's turning 70 years old, and he's just older. He's just ready to be retired. But he feels trapped. Why? Because he's selling for $1.8 million, and he owes about $500,000 in debt, and then he also has tax liability of $550,000. And so he doesn't want to trade 18 problems because he has 18 units, and that basically represents 18 problems in his mind. And he goes, I said, Peter, why did you do the Deferred Sales Trust? He goes, Brett, I had 18 problems. I didn't want to trade 18 problems for 36 problems. Right? I don't need any more problems. I don't need any more wealth. I need to be out of debt. I need more time, energy, and freedom with my family. I'm 70 years old. I want to enjoy my wealth. So what did he do? Well, he sold, and he paid off all of his debt, and he put about $1.3 million to the Deferred Sales Trust. And if you take that 8% on that extra $550,000 they would have paid in tax, that's about extra $44,000 per year. He's really happy. He was on my podcast. You can hear his story right now too. But leading to step 1, though, how do we make this thing an investment rather than an expense, right? We must charge hundreds of thousands of dollars for this. So we got to figure out how we're going to pay for this stuff, right? By the way, we don't charge hundreds of thousands of dollars for this, but we're going to walk through how that charges, but we're going to walk through how we can make this a saving. So you ready? Alex and Ashish, are you ready to work with me here?
Yes.
Okay, So Alex, I don't know what you make or if you want to share it, but let's imagine you're making $500,000 right now per year. And let's imagine about $250,000, let's make it $251,000 are coming from investment real estate properties, okay? Well, guess what? All of that cash flow you're getting as personal income. That's putting you in the highest tax bracket, okay? Let's say it's 518, okay, you're making, right? So you're in the 37% bracket. So Alex, would you like to drop all the way down to, let's say, the 24% bracket here? Or maybe the 22% bracket? Would that be cool?
That would be nice.
Okay.
Yeah.
All right. So, well, how do we do that? Well, guess what? The Deferred Sales Trust is a single entity business trust, which allows all of the income to just compound on top of itself, and Alex doesn't have to take it in personal income tax. So what can he do? He could sell that asset that's producing $251,000 per year, move it to the Deferred Sales Trust, and let's imagine it's producing $251,000 per year again, but allow it to compound on top of itself, which takes Alex's income, I'm going to use 440 and 200, and it's going to drop into the 240 bracket, which is going to be about $70,000 tax savings in 1 year alone. You following that?
Yep.
Okay. Now, at a certain point, you might say, well, my income dropped, Brett. Can I start pulling on the trust? Yep. Then we can turn it on and start pulling it on the trust. So it's your money. How and when do you want to receive it, Alex? Okay. Now, you might have some depreciation on a new cost seg deal. Well, amazing. That may take you 2 years to get that deal, though. Let's do that full cost seg study. Let's say there's $500,000 extra in that cost seg. Boom, Alex, guess what? Let's pull out $500,000 in the trust in that same year.
So, Brett, how long this has been around?
24 years. But it's not just the transaction, okay? It's not just the doctor who has the cure to cancer, okay? It's the one who knows how to execute the surgery, all right? So it takes a team of professionals at Capital Gains Tax Solutions, the tax attorney, Ashish, Alexander, the financial advisor, the CPA. We're all going to work together with you, the client. We're all going to help be your advocates. We're going to help you execute this business strategy. It's not like just forming an LLC. I'm showing you the tip of the iceberg. Below the surface is a lot of the surgery that's going on. Okay, but that's what our teams do. This is what we do every single day. Okay? So step number 2 is the estate tax savings, all right? So fast forward, Alexander, and you're worth $52 million. Maybe you're already worth that, or Ashish is too, who knows, okay? But imagine today you're married, about $23 million is exempt. But the rest of that is subject to about $12 million in estate tax. Ouch. Remember, estate tax has nothing to do with capital gains tax. Capital gains tax, you get a stepped up basis, which is like amazing, right? But even if Alex were to get a stepped up basis on his $52 million estate, let's imagine, his kids would have zero capital gains tax, but if he didn't move those funds outside of his taxable estate, guess what? It's subject to estate tax, 40% of anything above the exemption. So what's the exemption? Well, the exemption is about 23. Let's use 22 for right now. So on 30 million times 40%, that's $12 million. Ouch. So Alex, do you want to pay that $12 million or do you want to get it outside your taxable estate?
No. So I know, guys, we're going over time. So if anybody cannot stay, we're recording this. But we'd like to provide additional details. I know there's a lot Brett has to cover.
And I'm winding down here, folks, but it's going to be worth it. Stay with us. Stay with us.
But we'll be addressing your questions as well. We did not forget about you.
Absolutely. We will answer them all, okay? And so, Alex, most of our clients, before they meet us, they're higher net worth individuals, but they've been doing what's called family limited partnerships, and they've been doing some gifting, right? And they might look at a CRT, but they have to give it all away. They don't really like it that much. Well, guess what? The intent is to get it out before you pass. The challenge is you run out of gifting exemptions per year, or you run out of kids. Maybe you need to have another 5 kids so you have some more gifts to give away, right? But the challenge, you can't get it out fast enough. The solution is the Deferred Sales Trust. In one single day, in one transaction, let's imagine you owned a $30 million apartment complex. We can move all of that equity outside of your taxable estate using the Deferred Sales Trust, okay? That saves you $12 million. So back to the baby boomers and this $17 trillion that's going to pass. How many folks are in this high net worth that we could save all of that versus giving it to a government which will waste the money away, right? How much could $12 million do for your family or for charitable causes that you believe in?
That's a lot. Yeah.
Okay? This is what we're facing. And this is why we're spreading this message as fast as we can. And we need to execute it because it's happening. In the next 20 years, all of that $17 trillion is going to pass. Okay, moving on. Seamless partnership separation. Remember, we can go separate ways. really easy. We kind of already talked about that, so we're going to just keep going there. But remember, Steve and John, their partnership was breaking up, and they were able to seamlessly go both their ways and also save their failed 1031. And then remember, invest real estate advantage at your own timing. So this is all about why this is an investment and not an expense, right? If we can help you to purchase at a discount, that's why this deferred sales trust is an investment. And not an expense, right? Because you bought it at a discount. You bought it at $9 million instead of $10 million. Beautiful, right? The 1031, you would have had to buy it at $10 million. New depreciation schedule, right? The 1031 exchange, your old depreciation schedule traveled. That's not good. But this one, you get a brand new depreciation schedule. That's all savings for you. You can use cost segregation on top of that. You can also be debt-free, which decreases the risk, and you can also invest into multiple commercial real estate syndications. That can also help you make it an investment, not an expense. And then again, it can rescue a failed 1031 exchange or just be an alternative, okay? So we covered the 3 secrets. There they are again. And really, we truly believe these are transformational for you and your family, and we love the opportunity to show you that. So we're winding down here. Let me ask you just a few questions, and I want you to ask yourself this. If you just set a call with your trusted CPA, commercial broker, whoever, and an attorney, and with Capital Gains Tax Solutions to confirm that this works and is legal, Alex and Ashish, I'm asking you this right now, okay? So answer for the audience. If you could just do that, if you just set a call and we all just talked about it, and no cost call, all free, okay? And then if you were to just sit down with your financial advisor or your trusted professional and mapped out where and how the funds would be invested and how the risk would be accounted for and to make sure it's all protected. And then step number 3, you were just to sit down with me and map out how the deferred sales trust can actually be an investment and not an expense. Do you see, Alex and Ashish, how you can do this, how you can actually do this?
Sure.
Absolutely.
So let me ask you a question. You probably feel like this little girl right here. In fact, I have 5 kids, and one of my daughters, her name is Savannah, and she looks a lot like this little girl. You probably feel like it's a fire hose, right? It's just like, give me just a few more minutes, and I'm going to make you an offer, okay? And really just try to make this as easy for you as possible, okay? So I want to give you instant access. If you are a commercial real estate owner and you mention Ashish and Alex when you email me and connect with me, instant access to our online academy, which includes so much information that you can take it in at your own pace, okay? I know I moved really fast in this presentation, but you can just slow down and pause it and rewind it and everything else, okay? But if you were to do the deferred sales trust for yourself, you say, hey, I actually have a live deal. What am I going to get? Okay, I think I'm going to sell something right now. Brett, I need you to save my failed 1031. First of all, you're going to get white glove CPA tax attorney access. Bring your trusted CPA and get their education and blessing. You're going to get the lifetime audit defense, indemnification, and there's a $20 million E&O insurance policy that they've never had to tap into. You're going to get the transparent 24/7 access to view the accounts with real-time online updates. You're going to get the ADACA Sunwest account bank account set up. That stands for Direct Access Control Agreement. The escrow has all the funds all the time. It ensures the funds are protected and only move with your signature. You're going to get the white glove seamless transaction coordination from our team. You're going to get the white glove professional banker direct access. You're going to get the professionally prepared tax return service for your deferred sales trust with a 55-year-old CPA firm in California. You're going to get the white glove seamless LLC formation and funding coordination and onboarding. This is how to set up an LLC and get your LLC funded with the deferred sales trust. You're going to get access to some of the top wealth advisors in the U.S., okay? You're going to get the lifetime audit defense with the #1 installment sale law firm in the U.S. with a 100% successful track record. And then you're going to get access to Ashish and Alexander, and also access to living trust and estate planning services if you need it, okay? So again, who does this work for? Primary homeowner, business owner, car dealerships, tech entrepreneurs, dentists, veterinarians, optometrists, collectibles, artwork, Bitcoin, cryptocurrency, private stock, public stock. It works for real estate developers, syndicators, operators, LLCs, S-Corps, C-Corps, partnerships, LPs. It works for all types of high net worth individuals, okay? And you can see why these clients of ours could be paying $100,000 just to set up the deferred sales trust. Right? Maxine, Peter, Glenn, Dave, Steve. And I know this sounds too good to be true, right? Because you haven't heard about it. Don't worry. I felt the same way when I sat at Marcus and Millichap saying, this is crazy. How is my CPA not telling me about it? How do we not know about it? But don't worry. We have a reference list for you. You can talk to them right now. Number 2, bring your trusted CPA and advisor. Have them speak with us. There's no cost on our side. We will educate. We will put the trust together. We'll do all of this. If you don't want to use it, no problem. You don't owe us anything. So you can get started today for 1.5% on the closing cost and it's about 1.5% recurring on the net equity. If you're a business professional listening to this, we have an online academy. We want to train you and educate you so you can add massive amounts of value and grow your business. In fact, we just did a deal with a gal in Mountain View. She's a realtor, and she sold her own rental for $1 million, deferred like $200,000 in tax, and she's rolling it out to her clients. But we want to be able to train you, and that's for $97. You can get access to that. Anyone else, you have questions, we're going to answer them right now. But you can call me at 916-886-2986 or go to capitalgainstaxsolutions.com and start your education and transformation today. With that, I will open up to questions.
Excellent. Thank you, Brett. So first question is, I have one from Judy. Deferred until when? Is there an end date in this setup?
Alex, when would you like to pay the tax?
Never.
Ashish, when would you like to pay the tax? I can't hear you, Ashish, you're on mute.
Oh, sorry, I was on mute. Never.
Okay,
Never.
good. So yeah, most of our clients like to pay the tax the second day to never. You guys fit in right with them, right? So when do you pay the tax, and do you ever have to pay the tax? This is another way to ask the question. Okay, so as you receive payments from the trust, imagine it was a $10 million deal and it's producing, let's just say $1 million deal, and it's 6% at $60,000 per year. You'll pay ordinary income tax on that 60 on the interest payments. If you dip into principal, let's say you wanted to travel the world or go buy a fancy car or something, you dip in like say $100,000, well, you'll pay capital gains tax on that proportion that you receive. And then on the interest payments, just ordinary income. But most of our clients keep the principal intact and they just live off the interest, right? So back to Alex's deal at $5 million, and we saved him $1.3 million in tax. He'll keep the $5 million in place, and he'll just live off the interest, right? Think of it like an interest-free loan from the government. The government says, Alex, I'll give you that $1.3 million that you owe us. It's a loan to you, but at 0%. So Alex, if the government gives you a zero interest loan and says you can invest in real estate, how long would you keep that loan for, Alex?
Indefinitely.
You got it. So every 10 years you renew for 10 years, and then you can pass it on to your kids inside of your living trust, and they can step into your shoes and just keep it going. Next question.
What is white glove treatment?
That means you're getting the best of the best that are going to hold your hand, and your business broker and your financial advisor and your commercial real estate broker and your operator and your CPA by Capital Gains Tax Solutions, by the CPA and tax attorney who create the structure. We're going to make sure that this is as seamless for you as possible. We're not asking you to do the surgery, right? We're asking you to see the transformation it can make and to say yes to the plan, right? So we're gonna provide white glove service. If that makes sense.
Very good. Is there a minimum amount for this to work? I think you mentioned that it's for high net worth. So what's the break point where this actually does make sense?
Great question. So our minimum deal, we found about $1 million of net proceeds, okay, and about $500,000 of gain or more, okay. Gain is not to be confused with liability. So liability, $100,000 to $200,000, $300,000, which means probably like $400,000 to $500,000 to $600,000 of gain. And then the net proceeds about $1 million into the trust. That's what we found to be our minimums. Otherwise, our fees eat up the savings, and it doesn't pencil.
And then can you combine two assets for that minimum, or does it have to be a single asset?
Great question. Yeah, so it's one trust. Think of it like the mothership. And if you have like 20 homes, you can just sell one home at a time. They're each worth like $100,000, let's say. You can just slowly move them all into the trust, okay? And then as you move, it all starts to compile, and now you got all the money compiled, and then 80% can go out for a down payment for one big 150-unit apartment complex, right? So that's a great point. And you can also sell a primary home, investment real estate, business, all of them just go into the one trust. Okay, you just can consolidate all these assets, and then boom, it's nice and clean and simple.
Right.
And it can be in different tranches, like, it doesn't have to be around the same time.
Yeah, no, exactly. You can sell slowly, right? Yeah, so most people own multiple homes. The challenge with that, they have to compile them all together and sell it to an investor at 30% discount and then try to do a 1031. Don't do that. Just sell each of them with a 30% increase and move all of them just slowly into the trust and just compile all of the money at one.
Mm-hmm. Yeah, so we actually know a common friend. He's not able to make it today, but he's a high net worth executive. He's moving out of state. He's buying a home, selling the home in Bay Area. We've noticed actually a lot of houses on the market right now. I think a lot of people, especially tech, are able to work remotely, so they're relocating in a less expensive places. So the question is, he is selling his home. He's buying a new home out of state. He is also trying to sell a couple of commercial properties. So if I understood that correctly, he is able to combine all of these assets, sell them, set up a trust, and pay zero tax.
Precisely. Defer all of the tax. Just like if you were to do a 1031. When do you pay it on a 1031? When you stop the music, you stop the 1031, train, and you take constructive receipt. So why? The government gives us these legal loopholes to keep the money flowing. So they provided these things in place so that people would sell their property, and trust me, they're getting their tax because the broker is selling and paying tax, right? There's new property tax on it. The escrow company is doing the transaction, they're getting their tax, right? This person is probably going to take that money and go build another apartment complex, which is going to create more jobs and more tax. So the IRS knows what we're doing, right? They've seen us, they've gone through it. It's just an installment sale. And the other reason we think it's actually even better than the 1031, the 1031 recently was challenged to be taken out completely, right? They were talking about taking it out, and they actually limited it. But the installment sale goes back to the 1920s, and the reason it does is because they want to keep the people the ability to be the bank. The government doesn't want to become the banking system. And so in order to keep, if the economy completely crashes, they need to keep the ability for Alex and Ashish and Brett to be bankers ourselves so that the economy can actually keep going. So that's actually why it originally was in place. But now it's just about applying the law that's there. So that's why they're doing this. Don't think of it like I'm cheating the IRS. You're not cheating the IRS. The IRS is getting their tax when they receive it, and it keeps it into stocks, bonds, and mutual funds and real estate, which actually spurs economic growth. So they're actually winning here. That's why they do this, if that makes sense.
Mm-hmm. And another question was from Anna about the stocks. So you could, if you work for a company, you could exercise the option to sell and move the gains.
Yeah, so as long as it's not qualified, right? So if it's in some kind of qualified plan already, some kind of, something, give us a call and let's look at your plan. Let's look how you're in there and where it's at. But yes, generally speaking, yes, if it's not qualified money, right, and public or private stock, we need to look at, how it's set up. But yes, instead of selling it and taking it directly to you, you set up the trust, and we assign that to the trust and then sell it, and now it's in the trust, and now you can invest that into real estate, which is amazing, right? You can get out of the all-time highs and the craziness of the stock market and go invest with Alex and Ashish and a syndication. I mean, it's really going to keep you up at night, right, as you start to think of the possibilities here.
Ashish, do we have any more questions? Let me check Facebook.
Yeah, there is one question I have from Nick. He sent me a message, who worked for a large social media company based out of Silicon Valley. I sold some stock options and sitting on cash. How can I save on taxes and invest for passive cash flow in real estate? Can he use this vehicle?
So did he already sell?
Yeah.
So if you've already sold, it's too late. So we need to do this before close of escrow, right? Because what happened is you sold and the money went to your personal account. That's when the tax is triggered. So that's a great point. We need to set this up before close of escrow, right? So especially if it's a business or commercial real estate or a primary home, you have to do it before close of escrow because there's no 1031 option, okay? So you need to get with this early. And then that, you need to get the special language that we put into the contract. You can contact us for that, okay? And we need to put that in there. So be early. Now, if you're in a 1031 exchange, we can save a failed 1031, but you need to be working with accommodators that allow this. Not every accommodator is equal. They're like the old Blockbuster. They want to keep you in the Blockbuster. Go to Netflix. So we have those accommodators ready to go. Or if you really want to use your accommodator, bring them to us. And at that point, we can do it on day 46 is the earliest we can do it, up to day 181. The point is to get with us early and get educated now. But yeah, if you've already sold, sorry, you paid the tax. I'm really sorry.
So the question from Mark is, wouldn't reinvesting in opportunity zone be a better option?
Yeah, good question. And the opportunity zone, by the way, for that last gentleman, I actually was just thinking about that. You can still go into opportunity zone. You have 180 days to put that into a qualified plan and go there. Here's my take on opportunity zones. Generally speaking, a lot of the deals that I've seen I try to take out all the tax stuff, just take it all away and just say, would I buy this deal on its intrinsic value, or would I invest in this deal on its intrinsic value if it wasn't for my tax? And if the answer is no, or maybe I wouldn't buy it, then don't do it, right? We think that prices are at all-time highs, and they have been for 3, 4, 5 years, okay? Doesn't mean you can't find an opportunity. I'm not saying that at all, and especially out of state. But generally speaking, it's kind of like the 1031 thing. Like, you're selling high and buying higher. So just make sure you're buying a good deal. Now, if the intrinsic value is there, great, go for it. The other challenges with an opportunity zone, also on the Delaware too, which is in a sense like a 1031, kind of like an Oz, but a little bit different. You don't have liquidity, right? You're looking at giving up your cash for 7 to 10 years at least if you want to take advantage of all the opportunities, right? So if you're somebody who's like, you know what, I don't want to put all my eggs into just one deal and be tied up for 10 plus years. I like to have a little bit on my own. I like to have a little bit of liquidity. I like to have a little bit with, be passive. Then that's where we like ours, because you have more options, okay? The next one is you get a brand new depreciation schedule with ours. Oz, you actually, I'm not sure how, I think you actually might get a new depreciation schedule on that too, so that might be even there. But other than that, yeah, if you find a good deal, and by the way, I'm in commercial real estate, I love a good deal. If you can find a good deal on a 1031 or an Oz, by all means, go for it, as long as you don't need liquidity or want cash on the sidelines to jump on discounted deals. Again, I just have seen in general, a lot of Oz deals are overpriced, and it's development and it's speculative, and it could take a long time to actually see your cash. So just be cautious when you're looking at that.
Okay, let's have one more question. And I know we went way over, but I hope.
Yeah, but there is one more question left actually.
Sure.
Monty, Monty is asking, he will be selling his business sometime next year. He will definitely incur some long-term capital gain. How can I save on taxes? What are my options?
Yeah, so first of all, contact us now before you go into escrow, right? Let's do all the due diligence. We really encourage people to do their due diligence on us and the structure before they go into escrow, right? Because they're taking the stress and they're separating both of them, right? You want to be able to make sure you negotiate and maximize the sales price and not have to think about your tax deferral strategy, right? So get with us now, get connected, get to know us, look at the allocations, look at the investments, have that plan. Now that's set. Now, when you start to go into escrow, that's when you're going to connect us with your transactional attorneys. That's where you're going to connect us with escrow, and that's where we're going to make sure the language is in there properly, okay? And we're also going to overlook kind of the structure too, the tax attorneys, where to see if there's any other red flags. So we're doing so many of these deals. Again, if you don't do it, no cost to us, right? But we want to make sure we have everything in place to go, because if you don't, and then it closes, or the buyer removes all contingencies, it's too late. We're going to say, sorry, it's too late, you're going to owe the tax.
Very good. Well, we want to thank everybody for the time. I know there's a couple more questions, but we'll be sharing the recording with you. Brett, can you give the control to me? So I want to pass on our contact information as well.
Absolutely. So I think I click on this. And let's go ahead. There. Let's see here.
Are you able to
make host? Here we go. Wait. Is it? Did it go?
Okay, perfect. So our contact information is displayed on a slide. We'll be sharing this presentation as well. If you're watching live, if you can just message me or email me directly. We have tons of resources also on our website. As we mentioned earlier in the presentation, Ashish and I, we specialize in commercial real estate syndication model for busy professionals that would like to have passive income and not be involved in day-to-day. We have some free reports, blogs, and we're going to keep coming with additional content and invite amazing speakers such as Brett. If you'd like to participate in upcoming opportunities with us, you can also sign up for our investor club. And we just want to thank everyone who was able to attend tonight's webinar, and wish everybody an amazing evening. Happy 4th of July. Enjoy your Independence Day.
Yeah, happy 4th of July, everyone. And thanks, Brett and Alex. And quick point, I think some people requested for recording. So please drop in your email on Facebook under comments. Thank you.
Thank you, everyone.
Thanks, everybody.
Good night, everyone.
All right.
Bye.
Bye now.